taxation, real estate commission. Oh my gosh, they're huge. Check it out. So that's what we're reviewing tonight because they are big in real estate. So this is the book that we're using, and we're going to go ahead and get started with taxation because they are a huge part of real estate. Every property that we own, unless an individual is 100% disabled, pays taxes, property taxes. So in your exam, you may have to convert taxes or how much someone is going to end up having to pay taxes at closing date. Property taxes get prorated. So they're calculated by converting mill rate. So what is a mill rate? 1 mill equals 0.001. Okay, like 1 million. In Latin, un millón. A mill rate of 1 mill per 1,000 of property taxes. That's equal to 0.1%. A 1% tax rate equals 10 mills. So 1% of 100,000 equals 10 mills. So tax equals taxable value. So if the property is valued at, $500,000, you put the $500,000 up here, divided by 1,000, which is 1 mill, times the mill rate. The mill rate is what the city and the county will charge as far as a property tax on the assessed value of that property. It's not the real market value. It's the assessed value by the county. So taxable value, 500,000 divided by 1,000, 1 mill, times the mill rate, 1% tax mill rate. For example, a tax rate on a house with a 200,000 taxable value is 7 mills per $1,000. So we're having to divide the value by 1,000 first because the property taxes are calculated per 1,000 of assessed value. Keep that in mind. It's not the market value. It's not the current market value of a property that's for sale. It's a market value or assessed value. Some counties will include assessed value and also market value. So what is the tax? So the tax will equal 200,000 divided by the 1,000, 1 mill, that's 0.001, times 7 mills, because their taxable rate is 7 mills per $1,000. So 200,000 divided by 1,000, because they charge just on the $1,000 values, times 7 mills equals 1,400. So the tax rate for that property will be $1,400. Now the tax base equals the assessed evaluation minus any exemptions. An exemption could be a homestead exemption, 65 and over, disability exemption, or others. There are many types. The most common are homestead. It's their primary residence, and then 65 and over. And another one would be the 100% disability or some percentage of disability. Individuals with 100% disability do not pay property taxes. Example, a town has a total assessed value up to 20 million and exemptions of 4 million. What is the tax base? So the property value minus the exemption equals 16 million. So then that would be divided by 1,000, remove 3 zeros, would be 16,000, right? Times then the mill rate. tax base. So let me put the formula in the same page. So tax rate, base, and requirement. Tax rate equals the tax requirement divided by the tax base. The tax base is the property value after they deduct the exemptions. So tax base equals, so it's the same formula written to solve for a different factor. So the tax base, which is down here, move it over to the left, bring the tax rate to the bottom. You still have your tax requirement on the top. The tax requirement equals the tax base times the rate, okay, the mill rate. An example of that would be a town has a tax base of 660 million and a budget of 8 million. What is the tax rate? So the tax rate would be 8 million divided by 160 million, which equals 0.05. Convert that into a percentage, 0.5, move the decimal to the right 2 places, or 50 mils, right? Because we started that a 0.1% or a 1% tax rate. So a mill rate of 1 mil per 1,000 equals 0.1%, pardon me. A 1% tax rate would be 10 mils. So 1 mil here, 0.001. Okay, and it is a 0.1%. Okay, 1 mil, 0.001. Move the decimal to a percentage equals 0.1%. So the tax value, taxable value times the mill rate divided by 1,000. Oh, pardon me. Okay, so where are we here? Okay, so the tax rate, the base, and the requirement. So the tax rate, the base was 20 million minus 4 million. That's the exemption, right? So that's 16 million. So and then they have a budget of 8 million. So what is the tax rate? The 8 million budget divided by 160 million equals 0.5. So they're solving for here. Tax rate, tax requirement, tax base. Tax requirement, okay, and tax base equals 0.05. Convert it to a decimal, to a percentage equals 5% or 50 mils, right? Because 0.1% over here was 1 mil, right? So if it's 5 mil, if it's 0.05 mil, then you move the decimal to the right 2%. It is 5 mil equals 50 mils. Special assessments. There can be additional fees on property taxes, on new developments, on condominiums, on homeowner associations when they have a lot of repairs. So they may require a special assessment paid by everyone. So a special assessment equals total special assessment cost times the homeowner's value. It's calculated by the value of the property owned in that area that's being taxed a special assessment. So an example is a homeowner owns 100 feet by an 800-foot seawall. Okay, your units are there, feet and feet, that must be repaired. The total assessment will be $80,000. What is the homeowner's assessment? Homeowners share 100 feet divided by 800 feet equals 0.125 or 12.5%. The special assessment will be 80,000 times 12%, 12.5% equals $10,000. So that's what they're going to have to pay in that area for whatever repair or improvement needs to be made. Now, I haven't dealt with this with the exception of at a condominium subdivision where repairs had to be made, and they charged the individual based on the square footage of the condo or townhome. It's not an equal amount across the border. It's based on the square footage of the property. So commissions now. So that's it for taxation. Taxations are on rates, okay? And the base, which is the original amount minus any exemptions, as I mentioned, homestead exemption, disability exemption, 65 and over exemption, and there are others. So that it can come down to the final tax calculation, tax requirement, and reduce the property tax that's owed by that individual on that property based on their exemptions. All right, commission. This is realtor commissions. Commission splits. So once you pass your exam or before you pass your exam, you're going to be interviewing brokerages that you may be interested in or that friends recommended, other realtors or realtors that want you to go to their brokerage and they can get a percentage of profit share or revenue share from the brokerage. So the total commission equals the sales price times commission rate. So commission is earned when a transaction finally closes, and it's a percentage of the purchase price. So total commission, sales price, sell, purchase. One person is selling, the other person is buying, seller and buyer, times the commission rate. Co-brokerage split is the total commission times the percentage that is paid to the brokerage. So it could be an 80-20 split, a 70-30, meaning the realtor gets 80%, the brokerage gets 20% of the original total commission. And then the agent split is co-brokerage split times agent percentage. Okay, so the total commission times the brokerage percentage. So if it is a listing that was 6%, 3% will go to the buyer, the brokerage representing the seller. 3%, this is just an example. 3% will go to the brokerage representing the seller. So seller commission, buyer commission. They're not always equal. So in some areas, the listing commission may be higher. So that percentage is taken. So let's say, for example, the sales price is $1 million times the full commission of that listing, including buyer and seller side, is 6%. So 6% of $1 million is what? 60,000. So then the commission is split between two brokerages, right? The broker representing the seller, the brokerage representing the buyer. Sometimes the same brokerage represents both sides, or they represent one side and the buyer doesn't want representation, yet the listing agent will get the full commission because that is per the listing agreement. So the brokerage here, total commission times the brokerage. So let's say, as I mentioned, the commission is split by brokerage and selling broker and buying broker. So 3%. So the agents, so 3% of the total brokerage, which was 60,000, would be 30,000, right? Half of 60,000, 3% for one side, 3% for the other side. That's just a generic example. The agent split, it could be 80-20, 70-30, 60-40, 90-10. The larger amount is going to the realtor, to the agent. So if it's a 90-10 commission, the brokerage gets 10%, the agent gets 90%. So of that 30,000, the brokerage gets 10%, right? Which is 3,000. The remainder is 27,000. 90% of 30 is 27,000. So brokerage split equals co-brokerage split minus agent split. Agent split, co-brokerage split times agent split. So it sounds confusing, but you're going to deal with this with every transaction that you represent either a seller or a buyer. So when you're interviewing different brokers, make sure you ask, what is the commission split? And you might want to join a team. There you will have to pay a higher commission because you'll split your commission with the team who's providing you with all the tools, training, education, leads, and then the percentage that goes to the brokerage. For example, you could end up paying 50% to the team. And from your 50%, you're still having to pay 20% to the brokerage. So you're like, oh my gosh, well, I'm not getting anything. Well, keep in mind, you're a beginner and you're in a team that's providing you with all the tools, all the leads and training. It costs money to get that because the expense to the team is high. For example, a $300,000 property sells at 7% commission with 50-50 co-brokerage split. So that means 3.5% for the selling side, 3.5% for the buying side, right? The two brokers get 3.5%. And the split to the agent is 60%. So the agent gets 60%, the broker gets 40%. What are total co-brokerage, agents, and brokers commission? Co-brokerage, right? You have, if you're the listing broker, the co-broker is the buyer broker. Okay. The agent is the real estate agent under their particular brokerage and their brokerage commission. Total commission, 300,000 times what was the commission? 7%. So that is 21,000. The co-brokerage split of the 300,000, it said here 50%. So each side is getting half of the 7%. So 300,000 times 0.07, that's the full commission on the listing agreement. And each side gets 50%, which is 3.5%. That's 10,500 for each brokerage because the commission is paid to the broker, not the realtor. If the realtor is a broker, then the commission goes to them, right? Because they are the broker. Agent split, 10,500 times 60% equals 6,300. And then the agent's broker split is the remainder, right? 40%, 4,200. Okay, hi MJ, nice to see you. Can you put it on one page slide? Okay, let me see here. Okay, so there it is. The commission splits. And say Keller Williams don't want to offer a 90-10, which is a reasonable commission. Yet most Keller Williams have a 70-30 split. I was with Keller Williams in 2 different markets, or actually 3. And it's typically 70-30 plus a 3% franchise fee. So we're actually paying $18,000, which is the 30% they get. They want $18,000 of commission and $3,000 of franchise fee. So it totals $21,000 here in Texas in the franchises that I've been a member of. And sometimes they have a gradual increase commission split. So it can go as your sales increase, they could go from 70-30 to 80-20 and then 90-10, eventually 100%. Once we reach here in Texas 2.66 million in sales, at a 70-30 percentage, then we're at 100%, meaning no commission is no longer paid to the brokerage. However, there still is a transaction fee per transaction and an error and omission fee. So each brokerage is different. What is a reasonable commission? Reasonable can be you've got to interview different brokerages. Keller Williams basic is for beginners is about 70-30. Century 21, when I started years ago, was 50-50 because they provided the signs, they provided the paper, the printing, the website. They provided a lot of things, internet, phones. And as a person's sales increased, the commission split changed. So it went from 50-50 to 60-40, 70-30, so on. Keller Williams is not a transactional company. Transactional company is not for beginners because you don't know whether you're doing the documents correctly. Transactional companies are companies that pay 100% and you pay a flat fee per transaction. That is more for experienced realtors that have been for the business maybe 1 year and have done lots of transactions and they're well experienced. And you're pretty much independent. You're not getting much support. However, they do have a transaction review, compliance review. All brokers have to have that. So yeah, no, Keller Williams is an excellent company to get beginner training and interacting with a lot of other realtors where they help each other. They do have a set of training courses called Ignite. Now, keep in mind, I have not interacted with Keller Williams in a while to see if they have changed their training. However, I did call, I don't know, a month ago or so, and then they called me trying to get me to go back. And the split was still 70-30, unless you're a higher producing realtor, then they might say, okay, we'll start at 80-30. However, Keller Williams is a franchise. So the majority, 99% of Keller Williams offices are independently owned by brokers, and a 3% franchise fee is paid to the main corporation. Like McDonald's, Burger King, Chick-fil-A, they're all franchises. So Keller Williams has a franchise fee. I think RE/MAX, other companies that are franchises, there's a franchise fee. So in addition to the commission split, you may be required to pay a franchise fee. Keller Williams is 3% franchise fee, which is about $3,000. $18,000 commission if it's a 70-30 split, plus $3,000. So they're getting a total of $21,000. Other boutique companies may have a lower split. EXP has a lower split. It's 80-20 and a cap at $16,000. However, I don't recommend it for beginners unless you're extremely savvy and self-motivated and can get online and learn everything online, because all the training is online. Many realtors don't succeed with online companies, but there are some that do and do great. So, and that's because they do not have a brick and mortar office. EXP, Real, LPT, they do not have brick and mortar offices like Keller Williams, RE/MAX, ERA, Century 21. They all have offices that you go to. They have a brick and mortar offices. The other companies like EXP, Real, LPT, they're on the cloud. The office is on the cloud. You get to meet people from all over the nation, all over the world. Compared to when you go to a brick and mortar office, you meet the people in that particular office and go to their local meetings. So it depends. Since there's such a high failure rate of beginners because most do not understand what it's going to take to have your own real estate business. It's a lot of work, a lot of dedication, a lot of time prospecting, talking to buyers, talking to sellers, getting your individuals. And don't expect to get free leads from any brokerage unless you're on a team and they're not free. You're paying a split with the team and also to the brokerage. I want to work for an online brokerage. Okay, MJ, you want to be with an online brokerage, that's great. Just realize that you have to be extremely proactive, be very savvy with the computer, and be prepared to be bombarded with lots of emails to stay on schedule on the online training, online courses, online education, online meetings. Everything is online. There are some cloud-based companies that have offices, but that's only because the realtors belong to another brokerage and they had their own office, but they were, let's say, part of the Keller Williams, Remax, Century 21, Coldwell Banker, Umbrella, and they ended up opening their own office because they had a team. Individuals like that move from a brick and mortar company and go to a cloud-based company may still keep their office. However, that's for their particular realtors there if they have a team. But the big umbrella is online. It's a cloud-based company. So if you want to interact with a lot of realtors in person, then I would recommend a brick and mortar company. The realtors that we interact with in person with a cloud-based company is typically when we might have a weekly gathering or weekly presentations or weekly training, and we gather there. But it's not like going to a regular office. Everything else, there are meetings online from every cloud-based brokerage. I work as a cold caller and lead generation. Okay, so this is MJ. He works as a cold caller, so he does phone lead generation, calling leads that are provided by a lead generating company, and as a business development work from home roofing company. I need marketing strategies. Use chat GPT, Perplexity, other types of AI to help you with types of marketing. However, the company that you're with, cloud-based company, they will have marketing tools. Okay. No, that's okay. Those are good questions. Okay. And it's brought about by the topic that we're discussing right now, commission. So he says, sorry to get sidetracked. We can get back to the real estate math. Yeah, however, this all deals with commission, MJ. So there are very good questions, and it's important to ask in the middle of it because a question like that could be on your exam. Okay. All right. So the example was 30,000 property sales at 7% commission with a 50-50 co-brokerage. So each broker gets 3.5%. And a 60% agent split, meaning the agent gets 60%, the broker gets 40%. What are total co-brokerage agents broker commissions? The total commission, 300,000 times 7%. So it's 21,000. That is split between the two brokerages. Okay, divided by two brokerages, 50% each is 10,500. From that 10,500, now the realtor is going to get a split of 60%. That is 6,300. Pretty good for a $300,000 deal, wouldn't you say? Depending on how many hours you spent on that client. Sometimes we can make a lot of money with very little effort. It might be an easy to work with client and they find a property right away, or we're representing a seller. When it takes a long time, then we work really hard for that 6,300. And sometimes the transaction does not close and it falls out of escrow for different reasons. It can be the mortgage lender didn't approve their credit, didn't approve the survey, or didn't approve the appraisal because it didn't appraise to the value of the sales price, the purchase price. So seller's net. So the seller's net. Okay, any questions on commission? This is a very good question to ask when you're interviewing brokers. That's why I recommend interview different brokers so you know what to ask each broker. Ask each broker the same questions. And then create a chart for yourself and determine what value is each broker providing for you, what education, what training, what online presence, what marketing. There's so many services that are provided by brokers, apps to share with buyers and sellers so they can search for property other than just searching online, like with Zillow, Trulia, Realtor.com, Homes.com. There's so many ways to search online. Okay, no questions? Okay, we will proceed. So the seller's net. So the seller's net is the sales price minus the cost of sale. The cost of sale, all the expenses that are paid, commission, title company, title commitment, survey, appraisal, depends, if they're paying, contributing for closing costs, contributing for repairs. Those are all expenses, okay? And everything's negotiable between the seller and the buyer. Example, a home sells for $260,000 and has a loan balance of $200,000 at closing. The commission is $260, important value, $200,000 at closing. The commission is 7% and other closing costs are $2,000. What is the seller's net? So you start out with $260,000 times the commission. Must subtract the commission. That's part of their cost. So 260 minus 260,000 times 0.07, the 7% commission, plus other closing costs, 2,000, minus a loan balance that they've got to pay off on their current mortgage of the home that they are selling. So everything is accepted. So their net at closing will be $39,800. Some individuals are free and clear. They don't have a loan. So then it would be $239,800. So all costs related to the sale of the property are deducted from the sales price on the seller side. And closing costs could be the title policy, their tax fee, closing documents, things like that. On here, they didn't mention about buyer contribution or home repairs requested by the buyer. So this was a very simple transaction. So price to net amount. Price to net an amount. Formula. Sell price equals the desired net. What is it that they want to net? And that'll be a question they ask at closing, or that we ask them as a listing agent. What would you like to net out of the sale of your property? Plus the closing costs, plus any loan that they have to pay off, divided by 1 minus the commission rate. So 1 being 100% minus 7% commission rate ends up being 93%. Okay. So an example, a home seller wants to net $50,000. The commission is 7%. The loan payoff is $150,000 and closing costs are $4,000. What must the price be? So here we don't know the price. We're calculating the sales price. the price to list it for. So the sales price equals this formula. They want 50,000 to net walk away with in their pocket, in their hand, plus 4,000 closing costs. That's at the title company or at an attorney's office, whoever the escrow officer is, plus 150,000 that they owe in their loan, divided by 0.93. And you're saying, why are they divided by 0.93? Because it's a commission of 7%. So they're dividing the cost of sale with what they net, divided by 0.93%, which is 100% minus 7% commission, in order to get what the list price should be, in order to cover these expenses, their net and the expenses. You follow me? Okay, so this is working backwards, working to find out what the sales price should be when we know the commission, we know what their loan balance is, we know what the closing costs are, and we know how much they want to walk away with. So we add up all those costs divided by 100 minus 7%. So 100 minus 0.07 gives us 93% in a decimal, and that gives us 219,335. I mean 355. All right, good. You got it. All right, closing costs. So I put a whale on the thumbnail because a lot of these costs, taxation, commission, closing costs, can be huge for a seller and for us or for homeowners. So these are things to know. They can kill a deal, like the killer orca in the photo. They can kill a deal or they can make a deal. A home sells for $260,000 and has a loan balance of, no, pardon me, we already did that. Closing costs and proration. So the closing costs are what happens after there's an offer and it goes to the escrow officer, and all the expense of selling that property for the seller, minus any repairs that have to be done, any allowances that have to be done, taxes that have to be paid, and how are they prorated. If they have taxes and it closes in the middle of the year or any other time of the year, the property taxes are prorated. The seller owes property taxes from the date they owned it on that particular year to the day that it is sold. The buyer is from the next day to the end of the year. So the seller has to pay for their portion of the ownership for that year that the property was sold. And so that is credited to the buyer, and then the buyer gets that amount, and they have to pay 100% of the property taxes when they are due the next year. So on a 30-day, 12-month method, so prorations are usually done on a 30-day. Okay, so 30 days times 12 months is 360 versus 365. So did you need help with debit to the buyer, credit to the seller question? Can you break it down for me? Well, it depends if we go through this here. And it's going to be different for everyone. I would look it up on Google and look for a debit credit spreadsheet, okay, a settlement statement, a closing disclosure that has the columns for credit and buyer, credit and debit, okay, because it can get confusing, but I'm not sure it's covering it right here. Okay, so a monthly amount is the annual amount divided by 12. That's for prorations. Daily amount equals the monthly amount divided by 30 days. So proration equals the monthly amount could be, okay, $1,000 multiplied by the number of months, 12 months, right? Because we're doing it for the whole year. Prorations are done for the 12 months, plus the daily amount multiplied by the number of days. So an annual tax bill is $1,800. Closing is on April 10th. Oops, sorry. So a tax bill of $1,800, closing is on April 10th. What is the seller's share of the taxes? So we would take 18,000, okay, divide that by 12 months. So the annual amount here is 1,800. Divide that by 12 months, and we get the monthly amount. Now we need to find out how many days are there, January, February, March, and then to April 10th, in order to calculate what the seller's portion of the prorated taxes is going to be. So monthly amount 18 divided by 12 equals 150. Number of months, 3 months, January, February, March, right? Because it closes April 10th. So 3 months times 30, right, is 90 days. So daily amount, so now they're calculating the daily amount, 150 divided by 30 days, right? Because it's on a rate of 30 days, pardon me, on 30 days per month. So 150 days divided by 30 equals $5 per day. And then there are 10 days in April, right? So 10 days times 5, that'll be 50. But then we have 3 months. So proration equals 150. That's for the 3 months. Okay, 150 times 3, 150 times 3. So that'll be 450, right? Plus 10 days times $5 per month. That's 450 times $50 equals 500 seller share. So the seller's portion of the taxable, the taxes due at closing is 500. The buyer will be credited for that. So the seller owes that. So it's a debit to them and a credit to the buyer. On a 365-day method, the formula would be daily amount equals annual divided by 365 versus 360, or monthly amount divided by the length of the month. So proration equals daily amount multiplied by the number of days of that month. An example. An annual tax bill is $1,800. Oh, wait a minute. Is that the same one? Yeah. So now we're on the 365-day method. The other one was 360-day method, 30 days, 12 months. This is 360-day method. So it depends on that state or the title companies, the escrow officers, what method they use for the proration. So the example, an annual tax bill of $1,800. Closing is April 10th. What is the seller's share of the taxes? Daily amount is 1,800. Okay, 1,800 divided by 365 equals 493. Pardon me there. So the daily amount is 493. So now we go from January. Okay, let me try to put it all on one page. Okay, here. So the daily amount, again, 1,800 divided by 365 days equals $4.93. This is on a 365-day method. So January 1st through April 10th. So you go by how many days each month has. So January is a knuckle, is 31 days. In between the two knuckles is 30. March, April. So January is 31, February, leap year 28 or 29, right? And then March is 30. And then April is a 30-day month, but we only need 10. So here it'll be January 1 through, so January has 31 days, February 28 days, March has 31 days plus 10 days. That's an equivalent amount of 100 days. So now we go 100 days times the daily rate of $493 per day of tax proration brings us to $493 for that 100 day. That is credited to the buyer. So that is money the buyer is getting at closing from the seller. It reduces the amount that they have to bring into closing, and it increases the amount the seller has to bring to closing, or increases the amount that they get less at closing. Income received in advance, rent. So now for rentals. Okay, so the credits that some buyers will get, MJ, will be tax proration, HOA proration, or when the seller is providing a repair allowance, okay, then the buyer is getting that amount reduced from what they've got to bring into the table. So you can look up on the internet, okay, for, let me, hold on. Let me see if I can bring a page here. Bear with me. So you can look at settlement statement for real estate. So settlement statement example for real estate. So it has the debits and credits. Let's see if this will show it. Well, let's do a cash one. Cash closing settlement statement. Let's, come on, show it. So you can look at this, and you can also look in the prep book. It'll show what kinds of things get credited to a buyer or to a seller, and look for that. Okay, so example of credits to buyer in a real estate. And they'll give you a sometimes they'll give you a like a T-chart chart. Okay, well, they'll show you okay, they don't show one here really quickly, but key aspects of credits to buyers. Seller credit concession. The seller contributes a specific amount from their proceeds to cover closing costs. They make the purchase from affordable. Yeah, this is not what I wanted to see. So, Google something like this, okay, or go back to your prep book, credits to buyers and debits to sellers. Yeah, it's not showing it really quick here. Okay. So that's something for more detailed explanation on a different session. So here, income received in advance, rent. So that also gets prorated. Rent gets prorated on rental properties, homes that are rented. So any rent that the seller deposit that the seller has received will be transferred to the buyer, and any rent that has already been paid will be prorated, and the buyer will be credited with the rent that's due for the rest of the month from the closing date. So seller gets the amount from the contract at the beginning of the month to the closing date. So an example here, credit buyer and debit seller for buyer's share. Seller receives $1,000 rent. The month is 3/4 over, or 0.75 over. Buyer's share is $1,000 times 25% equals $250. Credit buyer, 250, debit seller. You can find a chart that shows you things like this: credit buyer, debit seller. You could have questions like that on the exam. So is it a credit to buyer and debit to seller, or is it a debit to buyer or a credit to seller? Yeah, review those. So here's an example, right? So the buyer is getting 250 because the seller has owned the property for 3/4 of the month. So they get to keep 3/4 of the rent. 250 gets transferred, gets conveyed to the buyer. Expenses paid. Expenses paid in arrears. Tax. Taxes are paid in arrears, okay? The same with utilities. We use it and then we pay for it. So logic, credit buyer and debit seller for seller's share. Example, buyer will pay $1,000 taxes. The year is 3/4 over. Buyer's share is $1,000 times 25%, right? Because it's 3/4 of the year over. So it is 250. So this one is simple. They're not doing it by 360 days or 365 days. They're just saying 3/4 of it is over. So you divide the 1,000 by quarters, and 1/4 is 250. So they credit the buyer 250 and debit the seller 750. So in the settlement statement or the closing disclosure, both sides, the seller and the buyer, have to be equal. Okay. Okay, we'll go ahead and finish. The last section of this math review is insurance. So we will do the insurance, and we're almost done with that section for math. And thank you for being here and participating. Okay, insurance coverage. Recovery with co-insurance clauses. Formula. Recovery equals the damage claim times percentage of replacement cost covered. That's the replacement cost that the insurance will pay after deductible, divided by the minimum coverage requirement. The minimum coverage that is provided by that company. Okay, I'm going to have to make it smaller so we can see it all on one page. Oh. There we go. So an example. That's kind of small. An example, an owner insures a home for $500,000. Replacement cost is $750,000. A co-insurance clause requires coverage of 80%, meaning the insurance covers 80% of the replacement cost, which is $750 of replacement cost, to avoid any penalty. Fire destroys the house. What can the owner recover from the insurer? Claim recovery $750 times 67% cost covered plus 80% required. So the 67%, A co-insurance clause requires coverage of 80%. So that's the 80% required here. The 67% is the replacement cost coverage, okay, of the insured home of 500,000. There's a 750. So claim recovery 750 times 67% cost covered divided by 80% equals 628,128. So 67% of 750, okay, divided by the 80% required, 80% of the 500 insured equals 628. If you have a calculator, you could do that to see that I verbalized it correctly. They don't show all the steps, okay? So let me run this on the calculator. Oops. Let's see what we come. If you have a calculator, I would ask that you also attempt to calculate this. Oh, no, what I got. No, I'm sorry. So they're covering 67%. So you use the, I'm sorry. So it's 0.67 divided by 80%. The way I explained it was that it was incorrect. So 80% is required out of the 67% cost that is covered. Then we get a percentage of 0.8375 times 750 gives us 628,000. Okay, they don't have all the steps included on here. However, they give you the number, 67% is covered. And then there's a co-insurance clause required 80%. So that's divided into the 67% cost covered on a replacement cost of 750. So the home insurance is 500,000. However, they're actually getting 628,127 in current market price value of material. Okay, because they've got to take current prices of material to rebuild that home. So they have their percentage of coverage divided by 80% of replacement cost. So that may be pretty good. It depends how long they've had the home and what kind of improvements they made. So the basis might have been 500,000, right? When they bought it, they could have added another 100,000, which would have been 600,000. Right, but the replacement cost at today's market value is 750 times the factor of 67% divided by 80%. So those are details that have to be looked on insurance policies. And of course, they also will have a deductible, which is not included on here. Okay, so that is our math coverage for this evening. Let's see, question here. Are you going to be doing any other sessions besides Tuesday, Wednesday, and Thursday? I attempted to do Saturday. However, I had family in town, so could not do Saturday. So that's what I was hoping to do Tuesday, Wednesday, Thursday, and Saturday. If I don't do Saturday, I may add Monday or Friday. So we shall see. I will inform and update on the YouTube side or on the Messenger groups or on the Facebook group that I have for Agent Prep. But thank you for asking. Okay, so that is it for the math portion. And again, should you have this book, Okay, if you have this book, we went through basic math, leases, contracts for sale, appraisal. Today we did taxation, commission, closing costs, prorations, and insurance coverage. And that insurance coverage, whenever there's a loan in place, is required by the lender to have the property insured prior to closing. That insurance coverage, the insurance has to be paid for a whole year in advance before closing. And then if there's when there's an escrow account, the lender will ask for 2 or 3 months extra to have a buffer to cover the insurance cost when it's due the following year. So those costs make the buyer's closing cost really high. Okay, the insurance and the escrow, and also for property taxes, they have to contribute. A lot of times the buyers will ask for sellers to contribute towards their closing costs. It can be 3 to 6%, depending on what kind of loan they have and what is permitted by that type of loan. Conventional FHA or VA or other government funding types of loans. Okay, so we covered in, I think, 4 sessions, the section, Section 2, real estate math and cramp cards. And I hope that that is helping you and that you're reviewing it. If you have any questions, post them in the comments and I'll get back with you on that. I reply to all of the comments that are put on the YouTube side after the session is in. Any comments that are placed on here, the replay will show up 24 hours after the video, the session ends. So 24 hours after, then you can see all the replay. Monday through Thursday, 6 to 7. It's perfect. It's nice how you like to ask, right? We don't ask, we don't get. Sounds good. So thank you so much, MJ, for participating. And I'm hoping that this is valuable to you and it helps you to prepare for your real estate exam. I say review lots of questions, redo the videos, go through them slowly. And my understanding is you have a good study schedule from 6 to 8 p.m. every day. That is excellent. You are committed and dedicated, and you have a schedule of how you study. That is crucial to prepare for the real estate exam, and don't do an all-nighter before the actual exam. If no further questions, I greatly appreciate you being here. I hope that my videos and my explanations will help you. And thank you for joining me this evening, and see you next time. Until then. Oh, and if this is your first time to my channel, I would love it if you could subscribe to my channel, thumbs up if you liked it. If not, better not to say anything negative, and write some comments and click the little bell if you want to get alerted every time that I go live. You're very welcome, MJ. Your exam is March 7th. I have time to ace it. Yes, you do. Until next time, catch you all later.